James Grant is here, editor of Grant's Interest Rate Observer. Jim, welcome back to Money Moves. Always glad to have you. So Mr. Lockhart actually speaking now, and I want to make some comments here or just bring something in, saying QE open-ended, but clearly not QE infinity. What is your take on that? What is your take in the context of what the Fed is doing? I know I can imagine, but I'd rather you say it, Jim.
You could say that quotation backwards and not impair the meeting.
Can also set it to music.
He said nothing. The Fed is on a campaign, according to Bloomberg, to let us know that it is concerned about possible, I underscore the word possible, distortions that its low interest rate regime is introducing into our financial markets.
So basically impairing the fixed income markets.
Well, these distortions are not possible, they are present. And for example, leverage loans, which are senior claims on corporate capital structures, now trade at a lower yield than do the subordinated junk bonds of the same corporations. A very rare sighting. What this boils down to is the consequences of price control. Remember back in college days, Deirdre, there was an essay called Politics in the English Language by George Orwell, which we were all assigned, and some of us read. And in this essay, Orwell admonishes us not to give in to the code words and the dishonesty that characterizes most political discussion. Well, here in finance, we are the prisoners of the same kind of language. For example, high-yield debt. It doesn't yield anything. Junk bonds now trade through 6%. Also, the Department of the Treasury, Deirdre, there's no net treasurer in the Treasury. It is the Department of Debt.
All right. Before we get a bigger picture, I just want to ask you, especially based on what you just said with high yield, I mean, is there a bond bubble, or has it already come, burst, and now we're in part two?
No, it has certainly not burst. A bubble, of course, is a defined term. A bubble, in some ways, is a bull market that one didn't foresee. The Treasury bond bull market has been underway for 31 years. No, it has not burst.
I meant more the high yield and some of the other products.
No, none of these things has burst. It's all there for the bursting. That's to come, as we say in the journalism trades, to come.
Okay, so next steps as far as you see Treasury playing a role. I know you've said that larger context, you have some real concerns. Well,
for example, there's this important discussion on the Treasury debt ceiling. Now, this is the debt ceiling that doesn't contain anything. But it's important that we lament our debt. It's important that we debate the 16-point-something trillion that constitutes the gross public debt, because there are no more checks on its growth other than civil and informed discussion. We used to have a gold dollar. There was only so much gold, is only so much gold, therefore there could only be so many dollars. That's gone. 40 years ago, it was gone. We used to have an interest rate structure that itself constrained the growth of the public debt because it became prohibitively expensive to borrow at rates of 6 and 7%. We borrow now at 2%. But Deirdre, if rates were as measly as 4%, we would be spending as much on covering our interest charges at the federal level than we currently spend on Medicare. So the distortion of interest rates, much of which is the consequence of Fed actions, has seduced us into a most dangerous complacency with respect to this immense debt.
So you've made the case then, instead of raising the debt ceiling, we should actually lower it.
Just by a symbolic dollar. Okay. Just by $1. I want to have somebody champion the reduction of the debt ceiling. And I also would like to hear someone utter the self-evident truth that this is a fiscal problem that is the underlying cause of which is a monetary problem, except for our pure paper dollar, which can be conjured on a computer screen infinitely, yes, and except for these midget interest rates, we would feel a real constraint on the growth of the debt. In the absence of a convertible currency, in the absence of real interest rates, there is no constraint on the growth of the debt, except when people like you ask people like me to sound off about it.
All right.
See, Deirdre,
I'm part of the system, Jim.
You are irreplaceable.
I'm irreplaceable. All right. Good to know. As far as what the Fed should be doing at this juncture, you have been a very outspoken critic of Ben Bernanke.
Well, it ought to get out of the business of price fixing. It ought to get out of the business of market manipulation. this kind of weaseling. We are now concerned about the potential possibility of consequences we didn't intend. Look, the Fed has imposed a structure of interest rates that is not only the invitation, it's the command to market distortions. And you see it in farmland. Esther George, the president of the Kansas City Fed, observed this. In Story County, Iowa, acres changed hands now for $17,000 per. Higher prices in other parts of the state. These are historically high prices and historically low returns to farmers paying these prices. And the source of the distortion is the Eccles building in Washington, D.C., where the Fed sits.
So if the Fed does less, or at least doesn't do more, do you think there's hope for us?
Yeah, of course. Deirdre, this country is indestructible. Try as the Fed might, it can't. What the Fed ought to do is say, look, we are so sorry. We are now getting out of the business of market manipulation. We believe in the price mechanism. As Chairman Bernanke himself told the students of George Washington University a year ago, he said, price controls miserably failed in the Nixon years. Well, what is the Fed doing except controlling that price we call the interest rate? So the Fed ought to say, we have erred. We have been on the wrong side of things. But now, thanks to Deirdre Bolton, we see the light, and we are now going to let the invisible hand do its work. And I think it would be infinitely better for the country and infinitely better, not, by the way, for the reputation of the Fed.
Do you think that that is part of what the Fed was signaling?
No.
No. Okay.
Sadly, no. I think the Fed is unchastened. What it wants us to know is that it is alert to the possibility it's all going to blow up in their face and in our faces. But, you know, in consequence of the troubles of 2008 and 9, what was the reaction? Well, the reaction included, the witness will now consult his notes, the reaction included the formation of new agencies in the Federal Reserve. And they want you to know that the large institution supervision coordinating committee is on the job, and they are looking for distortions. And the Office of Financial Stability, Policy and Research is likewise working 9 to 5 with an hour for lunch as hard as it can to identify these potential, mind you, potential distortions that are right in front of their eyes.
Jim, for those who are in the markets,
yes,
one idea on how to cope, what would it be?
Buy low and sell high.
Come on, Jim, you can do better.
Well, we've been writing about micro opportunities in micro-cap stocks. There are some. We have been, of course, we have been bullish on gold for a long time and still think it is one way of protecting oneself against the depredations of our central bankers. But I think an important thing to bear in mind is the Fed wants us to do things with our money. It wants us to get involved with so-called risk assets. But this is.
And you're saying resist.
Well, be very careful. Risk, by the way, is of course a defined term. People assume that Treasuries are innately or inherently safe because it says U.S. government on them. They are not innately anything. They are yielding 2% or less at the 10-year level, and not much more at the 3% for 30 years. And my goodness, you know, one false move with the CPI, one regrettable twitch, as the bond bulls would say, regrettable in the growth track of this economy, and you are underwater. So risk is, again, it's one of these words that Orwell admonished us to think about using. Risk is not about inherent characteristic of an asset class. Risk is derived from price and value.